stay tuned for this interview with Lance Roberts. Lance, how are you?
I will.
Lance, I'm making you the presenter. Looking forward to meeting you, hearing your voice, and seeing your screen. There we go.
I'm just curious which screen you're looking at right now.
I'm looking at Real Investment Advice, all the articles you have up there, Lance. So great to meet you. Thank you so much for coming here and giving us some of your time today.
No, absolutely. I'm happy to do it.
I believe I interviewed one of your associates up there, Michael Leibovitz. It was an excellent interview, and I've been following your work for a while on Twitter, and I go to your website, and I'm impressed with the content. I think content's very important nowadays, but I'd like to take you back in a time machine, Lance. So
sure.
Let's go back to right before you had an entree into the industry. How did it happen for you?
That was 1987. I actually started working for a bank. Yeah, no. Better than that, it was 3 days before Black Monday. So I actually graduated college. I went to work for a bank in Austin, Texas, managing their treasury book. 3 days later, after I start, the market crashes. My boss has me entirely convinced the entire crash is my fault. So that's the way I got started. Yeah.
You know, I think in The Wolf of Wall Street, the same thing happened to Leonardo DiCaprio. He had just gotten his Series 7, and then, a week later, he was fired. And
exactly.
And that began his great career as a penny stock whore. All right, he became a penny stock whore.
Well, here's an interesting story, though. I was actually, so that happened, all that part of Wolf of Wall Street happened right before the dot-com crash in 2000. And when, at the beginning of that movie, when they're trying to take that one company public, that was all real time. We were watching that, real time when that was
Madden.
Yeah, exactly. Michael Madden. Exactly, yeah. And that whole story when you watch that movie is a big flashback for me. So
yeah. Well, for me, it's trading places because I'm older than you, and I used to work on the floor, and I know that a lot of guys did take a lot of different substances when they went into the bathroom, mainly for ulcers. But
sure, of course.
So after that, what happened?
Well, no. And actually, I spent about 10 years working overseas. I spent quite a few years working for several different banks and doing a lot of real estate transactions and money management for high net worth individuals, primarily out of France, that needed offshore money management. And then in 1998, came back to the States, opened a broker dealer to continue operations. And then in 2000, saw the transition occurring after the dot-com crash. We started talking about the coming crash of stocks in late 1999, early 2000. We were warning people get out of the market. And then after that occurred, and of course, this was the initial advent. Back then, I was starting on a radio station doing a financial radio show, and there was a guy on the afternoons, and he was talking about, fire your broker, just buy ETFs. Well, there were only 3 ETFs at the time. It was diamonds, Qs, and spiders. That was it. Right. But he was very early on that whole ETF curve of lower rates, lower commission costs, etc. And so we transitioned our whole business into a very early adopter of the registered investment advisory, flat money management fee. We were at 1%. We were at 1% then, and the average fee at that time was 2 to 2.5, believe it or not.
Right.
And
now you have to pay somebody to manage it.
Almost, and so not only did they catch up to us at 1%, we're now managing money for between 0.5 and 0.75. So I mean, but here's the interesting
baton
part
death march of the retail industry.
Well, you say that, and let me tell you what happened in 2008. In late 2007, I was writing articles about the coming, bear market and the crash because of the real estate, the leverage, the stuff, the margin debt that was in the markets. In February of 2009, I wrote an article called 8 Reasons for a Bull Market, and we started allocating money back into the markets at that point.
Beautiful.
And I actually lost clients because everybody was convinced that the market was going to zero. But what was interesting is that actually, when the market came back around, the realization that good financial advice is actually worth paying for, fees actually went up momentarily. And then, of course, this big push into ETFs is now pressing fees down again. In the next crash, when it occurs, robo-advisors will go the way of the dodo bird, and fees for advisors will come back up somewhat, not to a great degree, but they will come up somewhat.
Okay, so you talk about those two previous experiences and going to an RIA model, and I think that's really what was behind people wanting to become self-directed. They saw, their broker, and that's what I respect about your work. You're not a passive RIA type.
That's correct.
You make moves, okay? And but most financial advisors, CFPs, whatever, they thought they were okay with the standard diversification, 70% stocks, 20% bonds, 10% cash, and people found out not once but twice that they weren't they were wrong on everything and wouldn't even open their statements for a while. So they decided, you know what, I'm going to learn how to trade. Do you think that was what was behind people wanting to become self-directed?
Two things. We saw this in 1999. You'll remember that day trading shops had opened up everywhere, and then, of course, when the market crashed, there was that shooting at the one in Atlanta, I believe.
They became position traders.
Yeah, exactly, and of course they were doing it heavily long. I had a woman come in my office in 2000. And she wanted me to help her fix her situation. Her problem was she was $250,000 in credit card debt. She had put it all into SDLI, JDS Uniphase, and a bunch of other stocks that went basically to zero. So we saw that same mentality back then of turning Wall Street into a casino for quick money gains. We saw the same thing in 2007, early 2008, and we see a lot of the same thing now. I am all for people managing their own money. In fact, we're Real Investment Advice. We're just in the final throes here. We're launching RIA Pro, which actually I was listening to the interview earlier. Very fascinating on the technical positioning. I came in late, but I was listening to his positioning on the DAX, and then he was talking about how he likes to listen to the fundamentals. Well, I'm very much a fundamental investor, and we manage money from a fundamental basis. So we look at valuations, we look at these type of things. I just wrote an article last week talking about marrying, though, the fundamental analysis with the technical overlays, because fundamentals are great, but what happens with fundamentals is they're very slow to turn. And of course, when you're in late stage markets like we are now, people start poo-pooing the idea of CAPE valuations and these type of issues. But it is at those moments where we start discounting the value of fundamentals and the fact that we're paying for a future stream of cash flows that we should start paying attention to these things. Here's a chart of this is basically the real inflation-adjusted S&P 500. Is this large enough for you, or do I need to make it a little bit bigger? Does that help?
That's better, yes.
Okay. So this is the top chart is the real inflation-adjusted S&P 500. The bottom is CAPE valuations. When the market has ever been above 23 to 25 times CAPE, you have had very long periods of very low rates of return. And so when you start talking about marrying some of these ideas together and talking about applying a technical overlay, that's what this does here, is simply looking at the same graph, but whenever the market goes below the 24-month moving average, and you see this over 100 years, there's not a whole lot of trades here, but it kept you out of the financial markets when you went through these very long periods of underperformance and overvaluation of the markets. We are very much in a period now at 31, 32 times earnings, and by the way, we're still carrying 31, 32 times earnings despite a surge in underlying earnings because of tax cuts. But we're in a period where we're going to see another major, decade or more of very low rates of return. and investors are unwilling to understand that.
How far away are we
the,
from that 200 or
uh,
whatever?
You're right. Right now, you're still a pretty good distance away. So just on a normal reversionary market, we're probably 12 months out from potentially a trading signal to the negative.
Okay. Okay. So you point wise, do you use it on the S&P or only the inflation adjusted S&P?
You can use it on either, but for the purposes of long-term analysis, we use inflation
Okay.
adjusted. Yeah.
Okay, so you think we're okay for 12 months? Any intermittent type of shakeout that could happen? I mean, the markets are pretty thin here right
Sure.
now, Lance. We could have a bear raid and clean out the lows of January, February, and then skyrocket again.
Yeah, absolutely. Look, we're moving into the two weakest months of the year, which is August and September. So we've got issues with Turkey. It's amazing how quickly, though, we dismiss these things in the markets. But that's very much a hallmark of a very overly complacent, bullish market, where we just quickly discount the issues of what's happening globally. But this issue with Turkey, and I had this chart in last weekend's newsletter, is something that really we shouldn't discount too terribly much, because the difference between today and what we saw back in
You talk about the Thai baht now, 97.
well, not only that, but we have a big difference between where we were and what was happening in Turkey. So what this chart shows you is the financial crisis back in 2008. You see 7 and 8. You see where the Fed's lowering interest rates. That's the green bar.
Right.
So you see the Fed interest rates going to zero. You see the surge in the underlying Fed balance sheet, and you see all the problems with Greece that we went through along the way. And every time we had a sell-off because of a crisis or whatever, the Federal Reserve was there liquefying markets, suppressing rates. We have Turkey going on right now, which is magnitudes larger than Greece in terms of its global impact, at a time when you have liquidity being extracted and the Fed raising interest rates, and the markets are completely discounting that. So I think there's a real possibility that somebody wakes up to, not literally tomorrow morning, but tomorrow morning, and we could see this market down sharply on some type of credit contagion that runs through this market. And again, if you go back through history and look at any period where there's been a financial crisis of some sort, it is always direct related back to some sort of financial crisis, generally driven by credit. Here's a chart of the 10-year Treasury rate going back to 1970. And at every point you had a spike in rates combined with a spike in the dollar, you wound up with some type of financial crisis, and we're running in that same mix right now.
See, that's what I love about your stuff. What's your account minimum for your RIA?
We really don't have a minimum. What we work with is people that really are serious about managing money long term. We're pretty selective about interviewing our clients when they're interviewing us to have the right mix.
Okay, so you probably wouldn't want me. Anyway,
probably.
I'd call and ask too many questions. No, I believe in leaving it alone, and I'd like to say that to anyone who would consider Lance as an RIA or a hedge fund or anything. Lance, I believe that people really don't give things enough time to make real good assessments. What would you say somebody should give you in the amount of time to have an understanding of what your performance would be? A year before they make any judgment, or sooner?
Hey, Dale, I'm sorry, I lost you there real quick.
Can you hear?
Yes, I'm sorry.
Okay. All right. People try and make judgments, in this business, especially in the spec end of it, in commodities and FX, you're only as good as your last trade. But when you're managing people's nest egg, how much time do you think is appropriate for people to make a good assessment on any money manager or RIA? About a year?
No, here's the way we spend a lot of time with our clients, and the issue is that in any given year, you hear this argument all the time, is like, well, 90% of money managers underperform their index, from one year to the next, and that's true, because the big difference between the S&P 500 is, and a money manager is the S&P 500, pays no taxes, holds no cash, has no trading fees, is not impacted by a variety of issues that impact your personal portfolio, but also benefits from things like share buybacks and share distributions, those type of things. So the index has a tremendous, and also one of the important things is stock substitution. So in other words, GM goes to zero when it goes bankrupt, they swap it out for another stock, and magically the portfolio or the index rebalances.
Yeah, the Dow is famous for that. Go ahead.
Exactly, and your portfolio doesn't work that way. So there's a lot of reasons why benchmarking to an index is not a great idea, but it is important as a tracking method about how you're doing. So what we do is we really spend a lot of our time counseling with clients and working with them. Look, you should approach your portfolio with your advisor as a business, right? So Dale, you and I, we're partners in a business, right? We're going to run a trading firm or whatever you want, whatever kind of business you want to run. Well, as we engage in that business, we work over the year and we say, you know what, sales aren't where they're supposed to be. So Dale, what do we need to do? We sit down, we restructure our marketing plan, we throw some dollars at it, and we relaunch our marketing plan to increase our sales. So we tweak our plan as we go along. And this is the important thing about working with any advisor, which is you should have a very good communication base with your advisor that says, as partners in this business, the portfolio is the business, we're the board of directors, what's going on here? Are you contributing to the plan as the money manager, managing the assets? You monitor this on a regular basis, and when you're off track, you make adjustments to get back on track, and this will allow you to inure value in your portfolio over the long term. And we are, just like you, Dale, while we use technical analysis to understand what the risk is in the short term, we are long-term fundamental investors. We use the technical analysis to avoid the risk in the short term of not only just capital loss, but also emotional loss. The biggest negative impact to portfolios over time is investors themselves, as their emotions drive positioning changes, et cetera, and portfolios that shouldn't be done, but it's that emotional drag that hits it.
Let me ask you this: with the charts that you've shown in real time, are you sitting on a fair amount of cash looking for that event risk to take the market lower for perhaps you have a shopping list if the market gets hit 10% or so that would be attractive to you?
Yeah, no, we're right now, actually back in January of this year, as the markets were running up to its peak, we actually reduced our portfolio allocations to about 75% exposure. So in other words, in a 60-40 allocation model, we reduced the equity allocations to 45%. During this bottoming process in March and April and this rally back, each week in our newsletter, we've been talking about increasing our exposure. We've been buying in on dips as they've occurred. So right now we're about 55% exposed to the market. We're still a little bit of cash, but we do have some hedges in place. And if this market breaks below 2,800, we'll begin raising some more cash within portfolios. But
okay, well, how do you hedge?
We hedge through several different methods. One, cash is always the best hedge to start with. Whenever there's a concern about the markets, people tend to make an emotional decision, so they go short the market. Well, the problem is when you move from a long position to a short position, if the market reverses very sharply, which we've seen a lot over the course of the last few years, particularly with Fed interventions, then you wind up moving from a losing position to a losing position. So the best first step for any trader is to immediately move to cash. Cash doesn't lose value, and it gives you time to evaluate what you do next. So you can monitor the markets. You can say, okay, the market is in fact going through a correction. Now I can short. Or that was a 1 or 2 day head fake, and we've seen that so many times here that we get some type of announcement from the Fed, or Bullard shows up and says, hey, don't worry about it, lower for longer, and this market turns right around and runs right back to new highs. Well, cash allows me the ability to buy back in on the long side if I need to. So our first step is always to move to cash. Second thing is that whenever there's a market rout, money moves into treasury. So we'll also add to our treasury. Bonds always are a good hedge. And now not corporates, not dot junk, etc.
Just treasuries, blue chips, and cash and T-bills, 90-day T-bills, not that much different.
Those are, they're not.
So what do you think of the bond market here? I think the most accepted narrative over the last 12 months is that rates are going up and the bonds have entered a long-term bear market.
That is very.
Action,
That's very much.
you agree with that?
No. And look, I've written tons of articles on this, but the issue is simply this: is that now we're talking about Treasury specifically, okay?
Right.
Not corporate bonds. We're not talking.
No, there's a huge bubble in corporates, right?
Exactly. So we're talking about Treasuries. This is where money flows to whenever there's world trouble, right? So
you're more like a commodity FX guy. You're looking at commitment of traders reports, your charts.
Yeah.
I lost you. You're a trader. You lost me? You lost me?
I'm sorry, Dale.
Okay. Okay, you're more like you have a trader's instinct, Lance.
Well, it's called 30. It's called 30 plus years of watching this stuff.
Okay. All right. All right. You watch stuff that traders watch.
Right.
A lot of commitment of traders, etc.
Sure. And the reason you watch this is because in the long term, again, it's fundamentals that matter. In the short term, and when people are talking about, well, rates have only one way to go but up. Well, you have to look at what drives interest rates. What drives interest rates is economic growth, inflation, and wages. Wages aren't rising. Economic growth is still plugging along at 2.5%, and interest rates and inflation remain fairly well contained around 2.5%. So when you add all that up, where should interest rates be? 2.5%. Where are we? About 2.5%. So it's in order for interest rates to go substantially higher, you've got to have an increase in the economic prosperity of the country, and there is nothing on the horizon that suggests that economic prosperity is about to come surging back in this country. We no longer manufacture, we no longer produce. Productivity is at historic lows because of the shift from a manufacturing base that we lived in back in the 60s and 70s to a debt-driven accumulation cycle beginning in the 1980s, which has only seen inflation, interest rates, and economic growth on the decline, because the more debt you contain, the less economic growth you're going to get because of the interest service required. And we've increased debt in households by almost 70% since 2009. And that's simply, you're going to hit the next recessionary cycle. Money's going to flow into bonds for safety, and you're going to see when these short positions, which are at the greatest level on record right now, reverse. And as you can see in this chart, what I've done is I've stripped out any net positioning that was less than 100,000 contracts. And what you'll notice is that every time you have this type of net positioning, this is generally a peak in rates, not the beginning of a run.
And this is the biggest.
Yes.
Record net short position.
That's
by commercials.
Yes.
Oh no, by
speculators. This is hedges, hedge funds, etc.
Lance, it was great to meet you. I'm glad I was persistent in having you come on, and you're my trading warrior brother now. So what's the best way? What's the best way for people to get a hold of you if they want to talk to you about their retirement funds or cash funds for you to manage?
Sure. No, best thing to do is go by our website, realinvestmentadvice.com. You can ask questions. You can I certainly encourage you to subscribe to our newsletter. This is a great way to learn more about how we view the markets and how we do things. This is last week's newsletter talking about this whole Turkey crisis right now. The newsletter goes through a variety of fundamentals things, and then we also do a complete positioning review on how we're positioning accounts. We even have a plan manager for 401k plans that we provide every week. So it's a great way to learn about us, and also just to help you manage your money better using our points of view.
What a great resource. Thank you so much, Lance. Good hunting to you and to all your clients. I hope that profits rain down on you guys no matter what the weather is. So
thanks.
All right, buddy.
Appreciate it.
All right, everyone. That's Lance Roberts. You can follow him on Twitter as well, @LanceRoberts. That's a wrap. See everyone for Wednesday session. Remember, don't just count your pips, count your blessings. See everyone tomorrow. Good hunting. Adios. Thanks again, Lance.